Professor.
Make an announcement?
I was going to make an announcement. I think Guy
Yeah.
emailed you about it.
It's 10:30, just
Let me get started.
when it gets 10:30.
Okay. All right. I like the microphone tap technique. It's a good way to get everyone's attention without having to shush.
Okay, it's all yours.
Go for it. Hey everyone. I just want to make an announcement. So Energy and Infrastructure Club will be having a energy and project finance workshop with Professor Godet this Sunday from 10 a.m. to 1. So if you're taking this class right now and can't get enough, or if you want to take a break from working on your corporate finance project, then come and join us. It should be a good time. So hope to see you there.
Okay. So I should remind you, even though reminder's probably not needed, that a week from today is your third quiz. Come on, guys. What is this? Surprise? There's no surprise. I mean, there are only like 3 weeks left in the whole class, so it's got to be in there somewhere. So it's a week from today. It'll cover pretty much, we'll be done today with all the material you need for the next quiz. So basically, it'll be capital structure, the first half of the second packet. So I'll send out more information in the next couple of days on it. Okay? So let's see where we were. We were on Monday talking about the right kind of debt for a company, right? And it's really not rocket science. It's trying to match up your debt to your assets. And let's give away the secret. The key to having the perfect debt for you is to have debt that behaves like equity around you, has all the flexibility of equity, while preserving the tax advantages of debt. So you're going to try as best as you can to put that flexibility into your debt. So the best way to nail this concept down is to take your company and design the perfect debt for it. So think out of the box. Think about all the things that drive the company and say, this is the perfect debt for the company. So what I'd like to do is complete that thought process today by looking at more specific ways in which you can tell me how long term. So you can tell me how much your debt should be long term, but how long term? 5 years, 10 years, 15 years, what currency? So if you want to ask specific questions about debt, today I'll give you some tools that might help you do that. So let's start simple. Let's assume you have one big project to finance. A big infrastructure project, or in the case of Disney, a big theme park. And you're saying, what's the right kind of debt for this project? The answer actually lies in the cash flows you use to actually analyze the project, because when you look at a project and you project out cash flows, normally you do it to compute the net present value. And if you take the Disney theme park, if you remember, these were the cash flows that I used to make a decision that this was a good project. So if you look at the first 4 columns, those are carried over from my capital budgeting. So essentially, I projected the cash flows for the next 10 years. At the end of the 10 years, I remember I estimated a terminal value, assuming the theme park would continue forever. And the net present value for this theme park, if I just add up the present value of the cash flows at the cost of capital, is $3.3 billion. So when we did investment analysis, we used this to conclude that this was a good investment. I'm going to build on that. I don't know whether in foundations of finance, I know you did, but I'll act like it might be still in doubt. Did Macaulay duration, do you remember what duration is? You have no idea? Let me review it very quickly. Macaulay duration, here's what you do. You take each of these present values you see in the second to last column, and you multiply it by the year in which the cash flow comes in. So year 1 cash flow you multiply by 1, year 2 you multiply by 2, and you carry it through. If you add up the last column, you now are getting the present value times T of whenever the cash flow comes in. See, where's this going? If I take that 62.355 billion and divide by 3,296, I come up with a duration for this project. We usually use this to compute the duration of a bond. I'm using the concept to compute the duration of this project. If I believe my own cash flows, this project has a duration of roughly 19 years. You're saying, what next? if you ask me what kind of debt should I take for this project, if my cash flows are right, the debt you take on should have roughly a duration of about 20 years, which really will translate into 30-year debt or even 40-year debt, because if you think about duration is always lower than maturity because you get coupons in the early years. So it's a way in which you can nail down the maturity of your debt by looking at the cash flows on your project. Yes?
Would this duration be the same if you had listed out 20 years?
That's a good question. I did cheat, right? Because when I put the terminal value in, that was really cash flows forever. You're saying, would it be? It probably would be slightly longer by using this compressed cash flow in year 10. I'm probably reducing the duration of this project. So that's actually a good question to ask, because you could project this out and say, what would the duration be if I went to 25 years? It's not going to increase by a dramatic amount. It'll be 22 or 23 years rather than 18. But if you have the cash flows in a project, you have the duration on the project. Now, if I asked you what currency should this debt be in? What are you going to look at? I projected in US dollars, but the cash flows are actually in Brazilian reais. And even that could be a little deceptive, because the people walking into the Rio theme park might be coming from Venezuela or Chile, or it's drawing tourists from all over Latin America. So even though the cash flows might be in reais, to the extent that exchange rates affect those cash flows, you could actually argue that the currency in which you'd issue the debt will reflect the mix of tourists you get rather than what currency they used to pay. I mean, I'd use the same analogy. If you look at the cash flows coming into Disney from the Orlando theme park, it looks like it's all in US dollars, right? But if you ever go to Orlando and you look at the line in front of you, a third of that line is usually Latin American, because it reflects the fact that it's pretty easy to get from Latin America to Orlando. And it'll reflect the strength of the US dollar against the real, the peso, and the other currencies. I still remember the peak of Latin American travel to Orlando was when the real was 2 reals to a dollar, when it was really strong. When it's 4.5, it's like doubling the price of a ticket. So you can think about individual projects and try to fund them at the right kind of debt. Now, this works only if you have big standalone projects, like the Disney theme park. Can you imagine how difficult this is going to be if I tried this on individual movies at Disney? It would be incredibly difficult to do. So the last approach I'm going to take you through is essentially going to try to use historical data on your company to design the perfect debt. So if you have a project, in this case, the project has to have a 19-year duration, or the debt should have a 19-year duration, and should be matched up in currencies. But let's think about how we can extend this concept to an entire company. To decide what the right kind of debt is for your company, I'm going to look at your history as a company. What am I looking for in the history? I'm looking to see how your cash flows and your value respond to changes in macroeconomic variables. I want to see, as interest rates go up, does your value go up or go down? When inflation goes up, does your value go up or down? And then I'm going to try to design debt with exactly the same characteristics. So there are two measures I'm going to focus on. One is your operating cash flows, to get a sense of how those numbers change as the macro environment changes. The second is the value of your entire firm, which is market value of equity plus market value of debt. And if you can't get market value of debt, use book value of debt. So I'm going to look at your history as a company to see how your company responds to changes in macroeconomic variables. I'm looking for clues that I can build into my debt. So with Disney, here's what I did. I went all the way back to 1985. I collected the operating income as a rough proxy for the cash flow, because I didn't want to do the cash flow each year. So that's giving me a sense of how your income changes over time. And you can see over this 28-year time period, the operating income for Disney, which started at $369 million, is now at $9.45 billion. The company has exploded in size. Its value as a company has increased from $3.5 billion in '85 to $126.8 billion now. So this has been a pretty good time period in terms of increased income and increased value. But I have information by year, so I computed the percentage change in operating income and the percentage change in value in the last two columns. And you can see that the worst year for Disney is that 2000, minus 23%. I think the best year might be the 49.2% jump they saw in 2004. But that's a percentage change in operating. In the last column, you have the percentage change in value. So I have 28 years of history on Disney in terms of changes in operating income and changes in value. So here's where I want to go outside Disney. I went and collected 3 pieces of information. And I'm going to give you a reference to one of my favorite data sites online. The first advantage is it's free. It's called FRED. It's a Federal Reserve site. And it's amazing how much data you can pull off. You want to know what the British pound US dollar exchange rate was in March of 1955? You can go pull it up. So if you get a chance, visit the site because you can pull up this data and you can download it to Excel. In fact, they have a little app you can put on your phone. This is if you're truly a geek and you want to look up GDP growth while you're standing there in line. It's a great site because you can pull the data. I pulled up the percentage change in GDP. What is it going to tell me? That's telling me how the economy is doing, right? So if that number is a big positive number, you're in a boom. If that number is a negative number, you're in a recession. So there's 28 years of percentage change in GDP. Then I looked at the percentage change in CPI, which is the inflation rate changing over time, essentially to get a measure of high inflation and low inflation. And the last column, I have the percentage change in the US dollar. You're saying against which currency? I actually, on FRED, they have this weighted dollar index, which is the dollar weighted by trade against different currencies, because I don't want to keep track of dollar yen, dollar pound. So this is kind of a combined measure of how strong or weak the dollar is. So when the number is a positive number, that's a year in which the dollar got stronger. That number is a negative number. It's a year in which the dollar got weaker. So changes in interest rates. So first I have the change in T-bond rate, the change in GDP, the change in CPI, and the change in US dollars. So here's what I'm going to do. I have 28 years of data on Disney. I have these 4 macroeconomic variables for each of the 28 years. I pulled them together in one spreadsheet. See what I'm going to try to do? I'm going to try to see whether there are clues in the macro variables about what's happening to Disney. So here's the first analysis I ran. I took Disney's firm value and operating income and looked to see how sensitive it was to changes in the T-bond rate. As T-bond rates go up and down, is Disney's value affected as a firm? And I'm going to argue that when you look at this relationship, you're finding out something about the duration of Disney's assets, and I'll show you in a minute why that link is going to work. So I took Disney's firm value and basically an operating income and looked at changes in interest rates. I ran a regression, a simple regression. On the left, my dependent variable is my change in Disney value. My independent variable is the percentage change in interest rates that year. It's not statistically significant. You can already see the T statistic is only 0.39, which basically means it's more noise. But for every 1% change in interest rates, if you go with this regression, what happens to my firm value? It drops by 2.35%. So when interest rates go up by 1%, my firm value drops by 2.35%. You might say, who cares? Now, there are 2 ways when you think about bond duration that you can describe bond duration. The duration of a bond is a weighted average of when the cash flows in the bond come to you. So that's one way to describe duration. So when I say the duration of a 10-year bond is 7.5, I'm saying it's on average, a weighted average cash flow. It comes in 7.5 years. What's the other way in which duration is usually defined? Sorry, what? It's how sensitive my bond price is to changes in interest rates, right? That's basically the way to think about duration. In fact, it is actually it's a derivative. It's how much does my bond price, so don't get intimidated by the calculus if you've forgotten your calculus. It basically measures how much does my bond price change for a 1% change in interest rates. So when I say the duration of a bond is 7.5, I'm also saying for every 1% increase in interest rates, my bond price decreases by 7.5%. You see what the connection I'm going to make is? When I ran the regression, what did I say this minus 2.33 was? For every 1% increase in interest rates, my firm value decreases by 2.33%. And I said a bond duration measures how much my bond price changes for a 1% change in interest rates. I'm going to argue that while the traditional way of estimating duration for a bond works fine for a bond, where you're given all the cash flows, if you give me an entire company, I can't give you projected cash flows for the future. I can look at the past, run this regression, and what I get as a coefficient in the regression, the B that you saw, will now become a measure of the duration of my company's assets. It's a very indirect way of getting there, But given the kinds of assets Disney has, if I trust this regression, I'm telling you that the duration of their assets is roughly 2.33 years. Why does that matter? Because when I go out to borrow money, I want to get debt that matches up my duration. So when I look at my debt, if this regression is right, my debt for Disney should also have a duration of roughly 2.33 years. So 28 years of data, regression, a very noisy regression, but if the regression works, you're getting at least a first sight of what the duration of this company's assets are. Any questions? Since I had the operating income, I also wanted to see how much the operating income changed at Disney for percentage changes in interest rates. This is a slightly stronger regression. Why am I saying this? The coefficient, instead of being 0.37, the t-statistic is 1.40. Not quite statistically significant, but I'm moving closer. For every 1% change in interest rates, as interest rates go up by 1%, my operating income drops by about 7.9%. So let me bring the two numbers together. When interest rates go up, my operating income drops by 7.9%, and my firm value drops by about 2.3%. Higher interest rates are bad for Disney, and now I have a measure of how bad they are by looking at that coefficient. So to the extent that these regressions give you information, they're giving you information about the duration of your company's assets. Okay? The second regression I ran was how sensitive Disney's operating income and firm value were to changes in GDP. Now think about what I'm doing here. I'm looking at how much my income and value are affected by GDP changes. GDP changes, we said, were a measure of how the economy was doing. You know, the question we often ask about a company, is this a cyclical company? And then we do a little dance and all these qualitative factors come out. It's a housing stock, it must be cyclical. But earlier in this class, I said it's getting more and more difficult to decide what's cyclical and what's not, because we live in an economy where 80% of the economy is kind of not real hard goods. It's not physical assets. So if I asked you, is Facebook a cyclical company? We can talk around it, but there's no easy way to answer the question. Maybe there is. If you can give me Facebook's history, like Disney's history, and I ran a regression against GDP growth, if it's a cyclical company, what should I expect to see as the coefficient on GDP? A positive number, 0, or a negative number? It should be a positive number. When the GDP is going up, my company should do well. When the GDP is going down, my company should do badly. If I see 0, I'm getting at least evidence from the data, but that my company is not affected by the economic cycle. And if I get a negative coefficient, what does it tell me about my company? I'm a counter-cyclical company. So this allows you to cut past the storytelling and say, hey, let's look at the numbers. Let's see if Disney is going to be a cyclical, a non-cyclical, or a counter-cyclical company. Before I show you the page, I want you to think, at least guess what we're going to find. Do you think Disney is going to be a cyclical company, a counter-cyclical company, or a non-cyclical company? It's cyclical, and that actually hasn't always been that way. When I first ran this regression in 1997, when Disney was more theme parks, didn't have a broadcasting arm then because it had just bought ABC, it was actually a non-cyclical company. The economic cycle didn't affect it very much. For whatever reason, I guess if you promised your kids you're going to go to Disney, you're going to find a way to get there, even if the economy is doing badly. Disney has become a more cyclical company as it's become more broadcasting, more movies, and you can see that by looking at the coefficients. Now notice that the t-statistics are above 2. You're saying, what's a little a next to it? That basically means that it's statistically significant at the 95% confidence interval. So I'm feeling pretty strongly that this is a relationship that I can back up with the data. For every 1% increase in GDP growth, and this is US GDP, Disney's value goes up by about 6.7%, and its operating income goes up by about 6.64%. To the extent that this regression is trustworthy. And I'm going to keep saying that about every one of these regressions because they're still low R-squared, high noise regressions. To the extent that this regression is trustworthy, it does look like Disney is a cyclical company. So let's see where we are. Disney has, based on its relationship to interest rates, a duration of about 2.3 years. Based on the relationship to GDP, it looks like it's a cyclical company. The next relationship I'm going to look at is how Disney is affected by changes in the dollar. Remember that weighted dollar number? When that's a big positive number, the dollar is getting stronger. When that's a big negative number, the dollar is getting weaker. So before again I show you the actual results, what should you expect to see if your company is hurt by a stronger dollar on the coefficient? A negative coefficient or a positive coefficient? A negative coefficient. So if I look at the coefficient and it's negative, it means you're hurt by a stronger dollar. If it's positive, you're helped by a stronger dollar. If I see a number close to 0, you're unaffected by what happens to exchange rates. So what do you think I'm going to find when I look at the numbers? Do you think Disney is helped by a stronger dollar, hurt by a stronger dollar, or unaffected? It's actually hurt, at least for the moment, because a stronger dollar seems to affect whether tourists show up at Orlando or Anaheim, whether they... But the reason I say for the moment is Disney's changing as a company. As its revenues increasingly shift to Shanghai and Hong Kong, it could very well turn out that the whole relationship could shift. But at least for the moment, here's what it looks like. Disney's firm value is negatively affected, but the coefficient is kind of marginal. It's 0.67. Disney's operating income is clearly affected. A stronger dollar is bad for Disney's operating income. By how much? Every 1% increase in the weighted dollar reduces my operating income by about 1.68%. Again, we're trying to map out how Disney is affected by those macroeconomic variable changes that we see around us. Okay? And the final, yes, go ahead.
A currency question, but
Yeah.
it's going back to the original
Uh-huh.
project financing. You were talking about the mix of tourism and Disney's theme parks and structuring your debt associated with those currencies. It seems like you introduce currency risk when you do that. You may like smooth out your actual expected cash flows based on your tourism, but you introduce other risks.
Well, the currency risk enters your operations with whatever you do. So let's say you have no debt, right? You build a theme park in Rio to get Latin American tourists, right?
Yeah.
Now, when the real gets stronger against the peso, you're going to be hurt because fewer people are going to come from Argentina to Rio to go to your theme park. So whether you take debt or not, you are exposed to currency risk on your operations, right? Now, all I'm saying is maybe we might not be able to make the currency risk go away, but by borrowing money in pesos or in Chilean pesos or Argentine pesos or whatever currency, I'm at least going to offset some of it. So the exposure to currency risk came when you built that theme park in Rio and you wanted tourists coming from outside. What you're trying to do with your debt is at least nullify some of that currency risk. So you're right, you're introducing currency risk on the debt side, but because there's also currency risk on the asset side, you're hoping that the two will kind of even out.
So I guess you could just hedge it out and hedge out the translation.
That's exactly what you're doing. You're trying to use a natural hedging. Instead of using hedges by using foreign currency futures or options, you're introducing it into your debt and building it as a long-term hedge. Right? Because if you think about the exchange rate shifting, both your asset side and your liability side are now affected in the same direction. You're hoping that the effects will at least partially offset.
I guess what I'm struggling, you've hedged out, say, the cash flow risk. I don't know if that's
Right.
the
Yeah, cash flow risk, fine.
But then you introduce a translation risk, which then you have to hedge out.
The translation risk is a pure accounting risk, right?
Yeah.
When you think about value, it's a transaction risk and an operations risk you worry about. So let the accountants do their little dances about you losing money or making money because exchange rates move. To the extent that you care about value, you're looking at the difference between your assets and liabilities. That's what you get as equity value. So you're right, there is an accounting exposure that you're going to see because you've taken that foreign currency, debt. But if you think about your economic value, you're actually safer now than you used to be. Let's do one final regression. I'm going to look at how Disney's value and operating income are affected by inflation. Think of what we're capturing here. I'm looking at how much my firm value and operating income change as inflation changes. So if I find a large positive coefficient on this regression, what's it telling me? As inflation goes up, my operating income goes up. As inflation goes down, my operating income goes down. You say, who cares? Remember we talked about fixed and floating rate debt? What drove that choice? What did I say was the key determinant of whether you're a good candidate for floating rate debt? Is whether you have pricing power, right? What does pricing power mean? If inflation is high, you're able to pass the inflation through to your customers. If you're able to do that, you're a much better candidate for floating rate debt. So if Disney has pricing power, they're a much better candidate for floating rate debt. So by running this regression, I'm going to get a sense of whether they have pricing power. And there are three possibilities. I can get a positive coefficient, which means they have pricing power. I can get a coefficient close to zero, which means that inflation doesn't affect their operating income or cash flows. Or I could get a negative coefficient, which means that as inflation goes up, they're actually squeezed. Their costs go up, but they're not able to pass things through. So it's the exact opposite of pricing power. You're powerless over prices. Again, let me ask you a question before you show you the results. Do you think Disney has pricing power? And where does the pricing power come from? We talk about brand name, that's really where brand name helps you, right? The fact is that if you're Disney, you're far more pricing power than if you're Six Flags. How does it show up? I've gone to the Disney theme parks probably once every year for the last 30 years, probably sometimes twice a year. I always claim it's for my kids, but I really like going. So even my kids didn't want to go, I'd go. But if you compare prices, just set up ticket prices across time, you'd see it's like clockwork. It goes up at the inflation rate or above, reflecting their pricing power. Let's see if the numbers back it up. So I ran a regression again of changes in firm value and changes in operating income against inflation. And again, if you look at the coefficients, every 1% increase in inflation rate increases my value by 3%, but it's not statistically significant. But every 1% increase in inflation increases my operating income by almost 8.2%. And that is statistically significant. Clearly, there is pricing power in operating income. It doesn't increase value for the simple reason that your cash flows go up, your discount rate also goes up. The value effect is a little muted. But clearly, if you look at these numbers, it looks like Disney has pricing power. You can extend this. If you have an oil company, what's a logical number to run this regression against? You want to see how much oil prices affect your operating income. Rather than dance around it and tell me a story, just look at the numbers. And I think I've thrown this number out before. If you do this for Royal Dutch, from 1989 through 2016, of operating income at Royal Dutch against oil prices, and you can get the average oil price each year, the R squared is 96%. 96%. So if you're doing Royal Dutch, why are you wasting your time looking at who the managers are? Who cares? Or what the cost structure looks like? It doesn't really matter. This is a bet on oil prices. Everything else becomes a side story. And to the extent that you as a company do stupid things when oil prices are high, it'll come back to bite you when oil prices are low. Like what? Like borrow money, like $100 oil prices will last forever. And then wonder what happened when oil prices go to 50. So take whatever variable that you think affects your company's operating income the most. Look at the numbers to see if you can back it up. So basically here at the end of this process, here's what I get from running these set of regressions. I ran 4 regressions. It looks like, if I believe these regressions, that Disney's assets collectively have a duration of about 2.3 years. That's a firm value regression against interest rates. It looks like Disney is cyclical. It looks like Disney is hurt by a stronger dollar. It looks like Disney's operating income moves with inflation, that they have pricing power. The only problem is every one of these regressions was really crappy. I never showed you the R squared, or maybe I did and I just glossed over it. The R squareds are like 6%, 7%. And that's exactly what you should expect, because we've seen this show before, right? Wasn't there a previous regression we looked at where we came up with a number and we wanted to dance with that number, and then I said, let's stop, look at the R squared in that regression. Where did we run into this before? Go back to your cost of equity calculation. What's the central number driving your cost of equity? Beta. And how are we taught to estimate betas? Run a regression of returns on the stock against returns on the market index, take the slope of the line, and you come up with the beta. And then we said, hey, that's nice, but the standard error is huge. I don't want to use that beta. And what was the solution that we came up with, or at least I came up with and pushed on to you to that problem? I said, instead of using one regression beta, use a bottom-up beta, an averaging of multiple betas. Do you see where I'm going to go next? I took the businesses that Disney was in, just like I did bottom-up betas, and I ran these regressions for every company in each of these businesses, the regression that I ran for Disney. Each of these regressions is crappy, but the average I get across these companies is going to give me a much more precise value. So let's see how this works out. If I take the broadcasting business and I look at all broadcasting companies and I run regressions of each broadcasting company against changes in interest rates and I average out the coefficients, the average coefficient I get is minus 3.7. What does that tell me? If I trust those regressions collectively, the typical broadcasting business has assets with a duration of 3.7 years. And I did this for each of the businesses. And then once you get the betas for each of the business, what do we do to get a beta for Disney as a company? We took a weighted average, right? In fact, I'd done the weights already in a previous context when I did the betas. I used exactly the same weights. And if you take a weighted average of these different business durations, the weighted average duration I get for Disney is 4.34 years. You are leaving some information on the table because this is for the entire sector and Disney might be special. But again, it's a way in which you can either confirm or change a number you get from the individual regressions, because those individual regressions can be incredibly noisy. So I'm going to send you the spreadsheet that I use. It's very simple. You put in 10 years of numbers for your company. You'll do all the regressions. But add that caveat. These regressions can give you strange-looking numbers because it's even worse than a beta regression because you can't even run monthly data or weekly data. It's going to be quarterly data at best, or annual data if that doesn't work. So these are regressions with 10, 12, or 15 observations. And the results can be all over the place. So at the end of this process, if you ask me to summarize what I've learned from the regressions, this is what I would expect to see if Disney is following the corporate finance rules. I would expect them to have debt of about 4.3 years, with a duration of about 4.3 years. Doesn't mean that all their debt has to have a duration of 4.3, but the weighted average duration of their debt, if you take all their debt, should be roughly 4.3 years. Second, I would expect a significant portion of their debt to be floating rate debt. Why? Because it looks like they have pricing power. And third, I would expect a significant portion of their debt to be foreign currency debt. Why? Because they're affected by the stronger dollar. So I haven't even looked at the balance sheet. This is what I would expect to see. Then I open up the balance sheet to see what they already have. And here's what they have. They have $14.3 billion of debt with a weighted average maturity of 7.92 years. What's my dream duration if they're doing it right? The duration should be about 4.3. Their maturity is 7.92 years. Maturity is usually much longer than duration, so that probably works out duration maybe 6 years. It's close enough, but if I wanted to be a purist, I'd say it looks like your debt is too long term. It should be a little more short term. Which actually, if you think about it, makes sense because Disney increasingly as a company is becoming a broadcasting company. That 49% of your value is in broadcasting. Not surprisingly, that's pushing the duration down. Second, I would expect a significant portion of the debt to be floating rate debt. Disney has about 5.49% of its debt. 5.67% of its debt as floating rate debt. I know it's subjective, but it doesn't look like it's enough. I would expect to see more. And if you look at their overall debt, only about 5.5% of their debt is foreign currency debt. And much of it is in either Indian rupees or Hong Kong dollars. Indian rupees because they bought an Indian broadcasting company, they borrowed money to buy the company, and Hong Kong dollars because they built the Hong Kong theme park. So if I were to look at this debt and pass judgment, I'm going to argue that it's far too long term, far too US dollar, and far too fixed rate. Yes?
Do you have any hypothesis of why their debt profile is what it is then?
What are the two things that drive much of corporate finance? Inertia and Me Tooism. Right? Part of the debt is so long term is there was a time when Disney was almost 50% theme park business, right? And didn't have to go back that far. 20 years ago it was half theme park, half everything else. As it's become less theme park, its debt has not kept up with the changes in its business mix. I mean, they never expected ESPN to become the monstrosity it's become in terms of value. When they bought ESPN, it was a rump broadcasting channel added onto their ABC acquisition. So as the business has changed, their debt hasn't changed. That's the first reason. The second is Me Tooism, which is, if everybody else in this business borrows a certain way, you borrow the same way. There's a third factor in many emerging market companies that I want you to think about. In many emerging market companies, you really didn't have much of a choice of what kind of debt you would take. You went to the bank and you said, I'd like 30-year floating rate debt, and the bank said, 3-year fixed rate debt, take it or leave it. And guess what? Every company in the market then has 3-year fixed rate debt no matter. So it's a combination of factors, Me Tooism, inertia, and the market constraints you face that I think lead to debt becoming mismatched. So how should I fix it? What are the two ways I can fix this problem? If it's a problem, if you view it as a big enough problem, maybe it's not big enough at Disney to create a problem, but let's say it's a big enough problem and you want to fix it. What's the first thing I can do? Actually, there are 3 ways. One is pay off all the existing debt and issue new debt. And 35 years ago, that would have been your only choice. 1970s, if you had to do a recapitalization of your debt, you'd have to retire all your debt. That's a pretty expensive process. Today you have swaps and derivatives that will help you kind of finesse your debt. How? How would you use swaps to, if you were at Disney and you wanted to fix this problem essentially overnight, what would your swap look like? What would you swap for what? Long-term, dollar, fixed rate debt for shorter term, foreign currency, floating rate debt. Hey, to me, that's the essence of swaps. It allows you, in a sense, to overnight fix the problem you had as a company. So the second way you can fix this is by using swaps. Or if you want to, you can use it, you can see how you can use options and futures to kind of finesse this. You can use foreign exchange futures to kind of, foreign currency futures to kind of make the difference go away. There's a third way you can fix this problem. Is Disney done investing? In 2013, they still had the Shanghai theme park they were going to build, right? If you were advising Disney on how they should fund the Shanghai theme park, what would you suggest they use? Remember, all you care about is your total debt after this is all done, right? And you want that debt to be more short-term, more foreign currency, more floating rate. My advice to them is take shorter-term debt than you normally would have on a theme park, make it foreign currency debt, presumably Chinese yuan or renminbi, and see if you can make it floating rate debt. And you don't even have to issue it in China. You could issue it in a different country and essentially swap it into Chinese yuan debt at the end of the process. Again, by either changing your old debt or by issuing new debt, you can make this problem become a smaller problem or even make it go away. For those of you who are going to go back to emerging markets, this is, I think, a huge area of opportunity because, as I said, for a long time in emerging markets, companies were constrained by whatever debt banks would offer them. That's it. So if you look at some emerging market companies, you look at their debt, it makes absolutely no sense until you step back and recognize that this was the only way they could borrow money. So if you could find a way to get this debt swapped into debt that's more appropriate, 2 things happen. One, the default risk for the company goes down. The second is they can borrow more money than they used to without exposing themselves to default risk, which pushes down their cost of capital and pushes up their value as a firm. You don't even have to change debt ratios. You're just changing the type of debt you have, and magically your cost of capital has just gone down because you reduced default risk. So very quickly, let me hit my 2 other companies and look at whether they have the right kind of debt. When I looked at Bookscape, right, it's a standalone independent bookstore in New York City, I would expect their debt to be US dollar debt, obviously, because they operate in New York City and their tourists are not exactly coming in from other countries. Right? So I'd expect it long-term dollar denominated and fixed rate. Why? Because they don't have a heck of a lot of pricing power as a bookstore. In fact, I'd like to tie the debt very specifically to the store. What does an operating lease do? It basically is dollar debt, it's a fixed payment, and it is tied to your store. There's a reason why retailers use lease debt. It actually makes a lot of sense to use leases if you're a retailer because it ties your debt to individual stores. So if you really absolutely don't like the way a store is going, you can walk away from a lease, and all it does is it's tied to the store. So if you're looking at Bookscape and you look at the fact that their debt is lease debt, it's actually the right kind of debt for them given the kind of business they're in. Now, if they plan to start an online retail business on the side and they come to me and say, what kind of debt should I use for that? That's a different question. I'm not going to ask them to use lease debt on that. But you can see why debt has evolved the way it has in the retail and the restaurant business. If you look at Vale, typical investment is in this long-term mine, 35, 40 years old, for 35 to 40 years in terms of length. The cash flows are usually in US dollars because it's a commodity business. It does get a big chunk of its revenues from China, 37% of its revenues from China. But because it's a commodity company, you can see the rationale for using dollar-denominated debt. Because in a sense, you operate almost entirely in a dollar environment. This morning I was looking at Severstal, which is a Russian steel company. I was valuing it for a different context. It's a Russian steel company, but all of its financials are in US dollars because it operates in a dollar-denominated business, the commodity business. Long-term dollar-denominated bond. And if possible, I would tie it to commodity prices. In fact, Vale wishes it had done this 10 years ago with iron ore prices. Because one of the things that got Vale into trouble a couple of years ago was as iron ore prices collapsed, the debt that they thought was manageable debt all of a sudden became unmanageable debt. Okay? So the existing debt at Vale is primarily US dollar debt, which makes sense. And it's a pretty long maturity, 14.7 years, which makes sense. But as far as I could see, none of the debt was commodity linked. In fact, that surprises me at commodity companies, that more commodity companies don't link their debt to commodity prices. Now I looked at Tata Motors and Baidu, no surprises. Tata Motors' typical project is long-term, but an increasingly large portion of Tata Motors is coming from their Jaguar Land Rover division. Their existing debt is mostly rupee debt, 71%. They have about 29% euro debt. But I would expect that debt to become more foreign currency debt as Jaguar Land Rover continues to grow as a portion of Tata Motors. Okay? And that'll be interesting to see how quickly Tata Motors reacts to the fact that they're no longer an Indian company with this foreign subsidiary. They're really a Jaguar Land Rover subsidiary that operates in India. That in fact their choices have to reflect that. And finally, Baidu is a young technology company. I would expect the debt to be more convertible than straight debt. Why? Because as a young company, remember your cash flows are either negative or low right now, so I want to keep your interest payments low. Make sense to be, and because all of their revenues are in China, I would expect their debt to be almost entirely in the local currency. And here there's a complete disconnect. Their actual debt, 82% is in US dollars and euros. There's almost no floating rate debt, and their average maturity is about 5.8 years, none of which makes sense. Wrong currency, wrong maturity. And the only thing you can hope is that they're doing something on the side to kind of protect themselves against the risk they're exposed to. I mean, whenever you see a country go into crisis and you see companies kind of melt down because they've mismatched their currencies, part of you wants to sympathize. But the other part of you says, this is exactly what you deserve. Why were you surprised? Because it's almost like clockwork. There's a crisis, there's a devaluation, and companies all of a sudden start blowing up. It's so tempting, especially in emerging markets, to go out and borrow in US dollars or euros. You know why? Because in the face of it, it looks cheaper. Borrowing in US dollars will give an Indian company a lower interest rate than borrowing in rupees, but it's deceptive. It's really not cheaper, it just looks cheaper, and you expose yourself to this mismatch. So it's one thing when Infosys goes out and borrows in US dollars. I understand that. Why? Because 90% of the revenues come from outside India. It's another thing when Bajaj Auto goes out and borrows in dollars because they still get 65 to 70% of the revenues in Indian rupees. You'd expect that debt to be a little more balanced. Any questions on matching of debt? Yes?
Back to Vale.
Yeah.
Are you saying that their debt should be tied to commodities based in the terms of the actual debt that they issue? Or
Yeah, I don't see why not, right? So why not just link your coupons to commodity prices?
Is that something that's actually done?
It's been done. Gold link. In fact, the very first commodity bonds were issued in 1980. Sunshine Mining, gold mining company, issued gold link bonds. But unfortunately, it looks like only the really small companies seem to be willing to do it. The bigger companies seem to think this is almost an insult because they feel they know what commodity prices will do much better than the unwashed masses. And for whatever reason, they don't seem to be willing to do it. But think of how many oil companies would be in better shape today if they'd linked their bonds to oil prices. It's doable. It's not difficult to do. You just have to create, there are ways to make it explicit. But for whatever reason, commodity companies don't seem to want to do it. Yes?
In restructuring, will lenders allow the borrower to change the currency of their debt?
In restructuring, what triggered the restructuring? Were you in distress or you just restructuring just because your debt doesn't match? In distress, your bargaining position, you'll take whatever they give you, right? The guy on the street offers you $100, you're taking it because you're so desperate for cash. So restructurings are a bad time to think about matching up debt because you have other priorities like survival. So you need to do this when you're healthy, because once you get, so right now if an oil company that's distressed tries to go out there and issue bonds linked to oil prices, this is like locking the barn door after the horse is bolted, or whatever the expression is. It's too late. So that's why it's so critical that you do this in the good times, when you're still healthy enough to do it, rather than wait for a crisis and then try to fix the problem, because then you're stuck with whatever the lender demands as terms on the debt. Yes? It's less like series of short-term debt that gets, And the pre-established terms are usually floating rate terms. It's not at a first rate. So it's like, to me, the difference between that kind of debt and floating rate debt is it behaves very much like floating rate debt, at least in my story. Because in a sense, it is going to be built on whatever the base rate is, LIBOR, Prime, T-bond, whatever you've made it. And your rate will be set on that. So it's nice to have that as access to capital, because if your default risk changes, you might still be able to access the debt. Though many of these debt issues do have clauses that if your default risk changes substantially enough that it's not going to work anymore. But at least it gives you access to capital in a market where you might be worried about capital drying up. It's less valuable in markets like the US, where there is capital access, than in emerging markets where you worry about capital markets shutting down. It's nice to have that conduit to capital. So they're all in that same group of debt for me, as floating rate debt. Any other questions? So let's put financing to the side, and let's turn to the third and final part of corporate finance. So essentially, we're going to focus on the dividend decision for the next 3 sessions. So there are 2 questions I'm going to try to answer. First is, now that you have your company analyzed in terms of investments and financing, first question I'm going to ask is, how much cash can your company return to its owners? And the second question I'm going to ask is, what form should you return that cash? It's a question that we brought up in the last session. Not all stockholders like dividends. Maybe they prefer buybacks. How do you make the choice between dividends and buybacks? So how much to return and how you choose to return. So let's think about dividends in a rational word. How do we describe equity? We describe it as a residual claim, right? If equity is truly a residual claim, here's how dividends should be set. They should be the last decision you make as a business, because the business that you run, you start off with your cash flows. The first decision you make is the investment decision by looking at projects and taking good projects. The second decision you make is the financing decision, which is interlinked with the investment decision. And after you've made your investment and financing decision, if there is any cash left over, that's what you pay out as dividends. That's a rational word. That's not the way dividends seem to work. There are many companies, more than I would care to number, right, where the dividend decision gets made first. They decide how much to pay in dividends and they work backwards from there. So we have to pay at least $2 billion in dividends. Okay, let's pay the dividend. And they say, oh my God, we have too much debt. So they'll try to fix that. We can't take projects. So in a sense, the real word, often the dividend decision becomes the driver of the investment and financing decision. That's why I'm going to describe dividend policy as dysfunctional dividends. Basically, in most companies, dividend policy is not rational. It's dysfunctional because dividends take on a life of their own. And the 2 words I used earlier, inertia and me-toosism, are dominant in why companies do what they do. I still remember when, and I might have mentioned this earlier, but BHP's CEO was asked, this is in 2015, the company's in huge trouble, it's losing money, it's continuing to pay dividends. And an analyst asked, are you going to cut dividends? Looks like you're in a lot of trouble. You know what the words he used were? Over my dead body. And that should be if you think about dividends, over my dead body is the way to think about why companies are so reluctant to change dividends. So here's what I'd like to do. I'd like to start off by giving you some general facts about dividends. And I'll describe what US companies do and what the rest of the world does. And the first word that comes to mind when I think about dividends, this is traditional dividends across the world, is that they're sticky. You know what I mean by sticky? If you want me to guess what your company will pay in dividends next year, most of the time all I need to do is look at what your company paid as dividends last year. This is not like earnings or cash flows where numbers jump around. Dividends are remarkably predictable because companies continue to do what they did. They either pay the same dividend or they grow it by a fixed amount. It's on autopilot. And let me back up that statement. This is actually a graph of what percentage of US companies increase dividends every year, decrease dividends every year, and do nothing to dividends every year. Every year from 1988 through 2016. In every single year, if you look at the percentage of companies that increase dividends versus decrease dividends, it's no contest. In every single year, the percentage of companies that increase dividends outnumbers the percentage of companies that cut dividends. And in every single year, the percentage of companies that do nothing to dividends outnumbers the companies that do something to dividends. That's the stickiness. Most companies pay out what they did the previous year. In fact, to show you how sticky it is, I took a quarter where bad things should have happened to dividends. Last quarter of 2008, right? Huge crisis going on. You'd think companies would be cutting dividends like crazy. Last quarter of 2008, it is true that more companies cut dividends than in any other quarter leading in. 17 companies cut dividends. But look, even in the midst of that insanity, of that crisis, 32 companies increased dividends. Even in the worst quarter, in the last 100 years probably, in the market, going back to the Great Depression, more companies increased dividends and decreased dividends. So dividends are sticky. Companies hate to change dividends, and when they do change dividends, they're far more likely to increase dividends and decrease dividends. So file that away as the first fact, and this is true in every part of the world. You go to Asia, you go to Latin America, you go to Europe, dividends are sticky. The only part of the world where dollar dividends or absolute dividends are not sticky is Latin America. Where Latin America, it's dividend payout ratios that are sticky. Companies pay out a fixed percentage of their earnings as dividends, often because they have voting shares and non-voting shares that are tied to keeping that payout ratio stable. So dividends are sticky. Companies hate to change dividends. Second word I would use to describe dividends is they tend to follow. Keyword is follow earnings. As opposed to what? They're not contemporaneous with earnings. They don't lead earnings. So here's the way it's going to manifest itself. Let's say you invest in a company and the company reports a big jump in earnings this year. Don't expect your dividends to go up this year. They expect a big jump in dividends next year as well. Maybe your dividends will increase next year, but it takes 2 or 3 or 4 years of increased earnings before a company increases dividends. It tends to follow earnings. It doesn't lead it. It's not contemporaneous. The effects of the 2008 crisis didn't actually show up in most companies till almost 2010. That's when they actually cut dividends. That's the response time between having a shock to your earnings and your dividends adjusting. So dividends are sticky and dividends follow earnings. In fact, if you look at the graph of dividends and earnings, you can see how much more stable dividends are than earnings, because dividends reflect that, that companies are reluctant to change. So again, if you can look at 2008, 2009, it's true, dividends dropped, but not by as much as earnings dropped and value dropped. It tends to be a much more stable number. So let me ask you a question. What's this fixation with dividends that we have? Why do stocks pay dividends? Or at least the way they are. Fixed dividend doesn't seem to make sense, right? If you have a residual claim, shouldn't your dividends be a residual dividend which will change every year? In good years you should pay more. So how do we get into this fixed dividend policy that seems, and it gets us into trouble because we have fixed dividends, right? Like BHP continuing to pay fixed dividends. How do you think we got started on fixed dividends? Think back in the history of financial markets. If you think about the early years of financial markets, investors bought bonds. That's how you invested. Stocks were latecomers to the process. So when stocks first came onto the marketplace and you wanted to induce people to buy stocks, what did you make them look like? You wanted to make them look like bonds. And how do you make them look like bonds? You attach a fixed dividend. In fact, if you get a chance, go on Google and look up these little, you can see these pictures of ads that were run for companies trying to sell their shares, and they're always marketed based on the dividend yield. You're making 4% in your bonds, you can make 6% as a dividend. Implicit there was also you were selling the fact that dividends are like coupons, they will continue to be paid over time. So dividends were started in a different age, an age when equity was competing with bonds for investors who were used to investing in bonds. 150 years later, we're stuck with fixed dividends. Where are we? There are two more things I want to add to dividends. First is that dividends are affected by tax laws. And let me back up. You invest in stocks, there are two ways you make money, right? You get dividends and you get capital gains. For most of the last 100 years, in fact, from 1913 to 2003, dividends were taxed as ordinary income. So if you were an investor in the US, you paid an ordinary tax rate. So if your income was taxed at 40%, your dividends were taxed at 40%. Capital gains were taxed at a lower rate, a capital gains tax rate. So for almost 90 years in US markets, dividends were taxed at a much higher rate than capital gains. In 2003, the tax reform that year lowered the tax rate on dividends and capital gains to 20%. So for the first time in US market history, dividends and capital gains are taxed at the same rate. So guess what companies started doing in 2003? Now that dividends were being taxed at a lower rate, more companies started paying bigger dividends. In fact, Microsoft, in the last quarter of 2003, paid, I think, the equivalent of $30 billion in dividends because they felt that this was the right time, now that tax rates were down. The only problem with the 2003 tax law was it was passed with a 10-year window after which the entire law expired. It's one of the stupidest things you can do in a tax law, right? They said, something will happen in the next 10 years. I'm sure we'll fix the problem. So the entire tax law basically sunset on December 31st of 2012. And the view was, we have 10 years, we'll probably figure something out before 2012. Did they? In fact, this was called the fiscal cliff. October of 2012, you get to the cliff, and they haven't done anything yet. And this becomes this gigantic, who's going to blink first? December 28th of 2012. So there's this uncertainty in the marketplace in that last quarter of 2012 as to whether the law was going to revert back to the old law. So guess what companies started doing in the last quarter of 2012? Because they were worried that dividend tax laws would change, they started paying out special dividends. Las Vegas Sands paid out 20% of its market cap as a special dividend. Why? Because they thought tax laws might change. They said, we're going to get ahead of it. What does this all show? Dividend policy can be affected by tax laws, and tax laws on dividends vary across the world. I'll give you extreme examples. You go to UK and Australia. If you're an investor in stocks, you actually are allowed, when you're estimating how much you pay in taxes on dividends, you're allowed to offset your taxes by the taxes the company has already paid. See, you're saying, what does that mean? Let's say your individual tax rate is 25%. And the company that's paying the dividend has a 30% tax rate. Your dividends are actually tax-free as an investor because you compute a 25% tax, you offset it against, you don't get a tax credit for the company, but at least you pay no taxes. So in the UK and Australia, dividends are actually tax-free to many investors. Capital gains get taxed. So guess what you see when you look at dividends paid by UK and Australian companies? They tend to pay much bigger dividends than other companies in the sector. In India, when you pay dividends as a company, you have to pay a 20% tax rate as a company. It's the Indian government's way of saying investors will never tell us how much they get in dividends, we won't collect taxes, so we'll collect it from you. Again, you're tilting what companies will do through tax law. So take a look at tax differences across countries because you will see dividends reflected. Yes?
Why does management care how its investors are being taxed?
Because I'm going to price it in, right? So think about it. My expected return on the cost of equity that we computed is a pre-invested tax cost of equity. So let's say you decide that to invest in a stock, you need to make 7% after your personal taxes. Because think, as investors, we get to keep only what's left after our personal taxes. So if I want to make 7% after personal taxes, and I pay a 20% tax rate, I'm going to gross that up and say I need to make at least 8.5% pre-tax to get to 7%. So the higher my tax rate on my collective income, dividends or capital gains, the more my expected return pre-tax is going to become, which means I'm going to pay less for your stock, a higher cost of equity. So when you see those equity risk premiums and risk-free rates, we used to come up with the cost of equity, those give you expected returns as investors before your personal taxes. So if your personal taxes increase, equity risk premiums are going to go up because that's the only way you can get the same kind of expected return after personal taxes. So the effect is through your stock price. So why should they care? That's where the corporate governance comes in. Maybe managers don't care. But to the extent that they do care, they have to think about personal taxes. Okay? Yes?
But on the other side, if dividends are being taxed at capital gains, corporations could pay out smaller dividends, would have the same impact to their investors on a cash basis, and then they would have more cash to invest on.
Is that a good thing?
Not
That's
because of the stock price.
no, forget about all. Is it good that companies reinvest more?
It should be.
Why?
With the ROE on projects.
If there are, and what do we see when we looked at that graph? 60% of companies around the world earn less than their cost of capital. I think one of the problems with dividends, I mean, there are a lot of people who think of dividends as a bad thing. They say, if you pay dividends, you're not reinvesting. If you're Hewlett Packard, I don't want you to reinvest. I want you to pay out 200% of your earnings as dividends and go out of business as quickly as you can. Don't damage me by hanging around and just sucking up my capital. So if it's a good company, you're right, I want them to reinvest. But there are lots of companies, I want to encourage them to return the cash. The only problem is dividends are not a very good mechanism to get them to do it because of the nature, because of the history. Once you start paying a higher dividend, you're stuck with it. So companies are reluctant to do it. So what's the other way I'd like you to return cash if you're not going to do it through dividends? Buybacks. And in fact, that's going to be my last graph. And this graph, I think, captures how dividend policy has changed in the US in the last 38 years. And this is a story that's rolling out across the world. When I took my first corporate finance class, there was a chapter on dividends. And it was all about dividends. There was no buyback. Nobody talked about buybacks. And there was a good reason. In 1980, only 3% of the cash returned by US companies came in the form of buybacks. 97% were dividends. A buyback was very uncommon. In fact, the chapter that I read in my corporate finance textbook was called the dividend puzzle. And the reason it was called a dividend puzzle was because of this tax issue. Why do companies pay dividends if investors get taxed at that time 70% on dividends and 28% on capital gains? It seemed absurd. But it was all about dividends. That was 1980. Starting in the mid-80s, you started to see companies buy back stock. And in this graph, I've actually graphed out the percentage. See this thick purple line? That's a percentage of cash that US companies return to stockholders that take the form of stock buybacks. So let's go back to 1988. 1988, about 30%, I know it's tough to read two axes, about 30% of the overall cash returned by US companies took the form of buybacks. That's up from 3%. So already you can see that 1980 through 88, you've gone from 3% to 30%. From 1988 through 2016, as you go through, there was this drop after 2008 for obvious reasons. The crisis kind of pushed back. But if you look at this line, it seems almost an unbroken upward line. By 2016, 60% of the cash returned by US companies was taking the form of buybacks. This is no longer debatable. The way US companies are returning cash has changed dramatically from paying dividends to buying back stock. So I want to throw that question out. Why do you think this has happened? Because it troubles a lot of people. They feel that this is the reason the US economy is not growing as much as it should, that companies are not reinvesting money. No. But let's look at why companies have shifted away from paying dividends to buying back stock. Anybody want to try? What do you think explains it? The shift to buybacks. Yes? The first is the sticky dividend, but that was a problem in 1980 and in 2016. So what's changed about the environment that makes that so much more problematic? Because in 1980, if you started paying a higher dividend, you were stuck then too. But companies didn't seem to care as much then as they do now. So what do you think's changed about the environment that's made it more difficult to maintain sticky dividends? Sticky dividends are not a problem if your earnings are also sticky, right? If you have stable, predictable earnings, you're going to be okay with sticky dividends. I'm going to make the argument that in 1980, if you looked at US companies, they had far more predictable earnings than they do now, partly because you were still domestic companies. You had these barriers to entry. If you'd asked me to list out 100 companies with safe, predictable earnings in 1980, I'd have had no problem listing them out. Today, ask me to list out 10. I'm already pushing when I get to 6 or 7 because fewer and fewer companies have safe earnings anymore. And if you feel insecure about your earnings, the way you're going to reflect it is by not paying dividends, but by moving to flexible dividends. I think of buybacks as flexible dividends because they allow you to pay dividends in the good times and hold back. Yeah.
It also shows how much cash companies are holding, like on their balance sheets versus.
That's another graph, because that would actually be the percentage of cash returned as a percentage of overall cash, which we'll come back and look at, because that difference must be also growing because we have this $2.5 trillion in trapped cash that people talk about in bigger cash balances. So that's almost a second issue. This is once you've decided to return the cash, whatever cash you've chosen to return, less is being returned in the form of dividends. And I think this is going to only continue, and it's going to spread across the world, because when you look across the world, this is no longer just the US. Last year, 30% of the cash returned by European companies took the form of buybacks. Some of people think this is just a US phenomenon, but it is in fact a phenomenon spreading around the world. Yep.
Is there any activist investor component to this?
There could be, but an activist investor just says, give me more cash, right? They don't care whether you pay the cash back in dividends, whether you paid in special dividends. So that might be a trigger to more cash, and in fact, that actually pushes against the other trend line, which is companies are holding increasing cash balances, not decreasing cash balances. Some companies clearly feel the pressure from activist investors, but that by itself doesn't explain the buybacks as opposed to dividends. But there might be a related point. Now, in the 1990s, managers were given compensation in the form of options. Let's say you're a manager and you're rewarded with options. Might it color your decision on whether to pay dividends or buy back stock? Now think about it, right? You get options. Options come at the strike price. If you pay a dividend, what happens to your stock price on the day of the dividend? It's going to drop by roughly the amount of the dividend, right? It's not a bad thing. It's the way it works. Whereas when you buy back stock, you reduce your share count, your share price goes up. So there might be a selfish reason that managers have for shifting away from dividends to buybacks. But to me, the very best reason for buybacks came from, this was my daughter was 8 years old. She's a financial genius. She came up with this explanation inadvertently, but no. So she was 8 years old. I had to drive her to a birthday party. So she gets in the back seat. She was tiny. She straps herself up. And then she says, turn the radio to Z100, station that gives me a headache. So I turn it on because she's very, very persistent. And there are all these songs I've never heard by artists I've never heard. And then the songs end, the DJs start talking to each other. And they start talking about hooking up. To show you how disconnected you get after 25 years of marriage, I had no idea what they were talking about. So my 8-year-old pipes up from the back seat, giving me an explanation, a convoluted explanation of what hooking up was. Now part of me is in shock that my 8-year-old is explaining what hooking up is. The other part is saying this is a great way of thinking about dividends and stock buybacks. And here's the way to think about it. Dividends are like getting married. In good times and in bad times for the rest of your life. Stock buybacks are like hooking up. So here's the way I describe the world. Companies used to be interested in getting married to investors, long-term investors who held the stock for 40 years. Nobody's interested anymore, neither companies or investors. They want to hook up. So there's $5 billion, never seen you before. Let's move on. So if somebody asks you what's going on, why are buybacks going up, that's the reality is essentially companies don't want to think about long-term commitments that lock them in. Buybacks are a way of getting out of those commitments. So if you think that this phenomenon is going to disappear, it's not. And in fact, to show you how it's spreading around the world, I broke so at the start of 2017, this is part of my dividend post. If you get a chance, go back and read it. I broke down the world into regions. There are the dividends in the first column. There are the buybacks in the second. And basically, I look at what percentage of the cash returned takes the form of buyback. So if you look at the Africa and the Middle East, only about 5% of the cash returned. So 5.11% comes from buybacks, 95% from dividends. If you look at Australia and New Zealand, only 11%, but Canada is up to 32%. Not quite as high as the US, but you can see if you look across the regions, the US is 56, the UK was 55, the UK was 21, but you can see that the phenomenon of buybacks is starting to spread around the world. And it took longer than it should have because for much of the last 20 years, there are parts of the world where buybacks were actually not allowed. You were not allowed as a company to buy back stock because it was viewed as market manipulation. Germany, for instance, until the mid-90s, you couldn't buy back stock as a company. So when you think about dividends and buybacks, I think we have this habit of treating buybacks as something new and different, just a different way of returning cash. And as an investor, sometimes you might prefer dividends and sometimes you might prefer buybacks. And sometimes for two different parts of your portfolio, you might require different things. So on your 401k, you might want to get dividends rather than, because you don't get taxed anyway. And on your savings, the regular savings, you might prefer buybacks because you get taxed on dividends. So it gives you that potential advantage you might not otherwise have. Yes?
Unless the buybacks affect the marginal price, I don't know why an investor might actually
How can they not affect the marginal price? So let's play again.
If it has to be big, the volume would have to be big.
But I'll tell you why even the price doesn't have to change. Let's say the stock price is 50, right? And let's say I'm a $50 million company and I have $1 million in cash to return. I can pay it as a dividend or I can buy back the stock. Let's say the stock price is not affected by the buyback. It stays at 50, right? But if I pay the $1 million in dividends, I'm definitely going to affect the stock price. Think of why. Because on the ex-dividend day, when I pay the $1 million in dividends, my stock price has to drop by roughly $1 million. Otherwise, people will be making money hand over fist. So as an investor, you're really given a choice between $4.90 in price and 10 cents in dividends and $5 in stock price. It doesn't even have to, I don't even have to tell you a story of how buybacks increase the stock price. I could tell you that story, but I don't have to. It's just a choice between would you rather get the dividend and see your stock price go down. So basically what you're getting is a replacement of what used to be a capital gain with now an ordinary income, right? Because this year when you report to the IRS, you will have to report that 10 cent in dividends as income that will get taxed on. Whereas if it had not been paid out, it would have been untaxed because until you sell the stock, you don't have to pay capital gains taxes. So it's not even an involved story of buybacks pushing up prices because they don't always do that. It's really a question of would you rather take the price as is or the price net of the dividend? And that's what makes it a trade-off. Would you rather receive ordinary income or do you receive capital gains? Okay. Any other questions? And let's do the final piece. Dividends are different across the world, and I talked a little bit about why this is. But I think the best explanation is tax laws vary across the world, which explains why parts of the world you see much higher dividends than other parts of the world. And I think that wherever your company is incorporated, one of the things I would explore is what are the tax laws that affect dividends and capital gains for investors in that country. So dividends are sticky. They don't change very often. When you see a change in dividends, it's far more likely to be an increase rather than a decrease. Dividends tend to follow earnings. They don't lead earnings. Dividends are affected by tax laws. And increasingly, dividends are being replaced with buybacks around the world. And it might only be a matter of time before the dividend as we know it is going to, it won't disappear because there'll be old companies that continue. But when Google starts returning cash, it might choose to return it almost as a residual dividend. And here again, the question you got to ask is, if you're a commodity company, why would you ever want to set a fixed dividend? Why not set your dividends based on what oil prices are, what your cash flows are? Again, it's a plea for building in flexibility into companies, because if you don't build it in, it comes back to haunt you in the bad times. Right? Any questions about dividends, buybacks, or the rest? Right? If you want to find out how much companies are buying back, S&P on its website actually has a history of buybacks for the S&P 500. It's the data that I use to compute the implied equity risk premium. So you go to the website, you click on it, you can download an Excel spreadsheet that shows you the buybacks over time. There's now an ETF of exchange-traded fund of stocks that do buybacks. So basically, it's for those people who think stocks that do buybacks are better investments than the rest. So you can slice and dice the market any way you want. Just don't fall for the fear-mongering that you often get around buybacks. The fear-mongering often is buybacks are bad. Why are buybacks bad? Because companies are returning too much cash. Too much is, it depends on where, who's returning the cash. If you look at the top 20 companies in terms of buybacks and you go down the list, there isn't a single company in the list that I'd want investing that cash. So if you want to make a case against buybacks, it's got to be a more nuanced case than, hey, they're returning a lot of cash. So I'm going to stop there. I almost never stop early. What's wrong with me? But we'll stop. And I will send out the link for the past quizzes if you want to start working on them. But the third quiz is a week from today. So there's a trade-off, right? Yeah. You have a higher interest rate debt, but it's more flexible. Right. Because basically, and if the lender's really worried, he can actually go in and hedge the oil price risk if he wants and get back to a fixed rate. But that's the trade-off. You accept higher interest rate debt for more flexible. Hi, how are you?
I emailed you from my team.
Yeah.
Regarding
Yeah. Good. I'm glad.
Because I came from the front end side, and once like
Hope you get you.
yeah, just want to
Glad you got back.
okay.
Take care. Take care.
Real quick, this cash payout, what is this?
That's cash payout ratio is basically cash as a percentage of the cash return. So you look at this number, for instance, the fact that it's greater than 0%, means that US and UK companies are actually returning more than their earnings as cash. The collective, if you take dividends plus buybacks of US companies, dividends divided by earnings is traditional payout. Dividends plus buybacks divided by earnings is cash payout. So the regular payout, they don't look back. They're paying out 40-50%, but it's deceptive because we add the buybacks, they're actually paying out 120%. And that's potentially a problem, right? Because if you keep paying out more than your earnings...
How do you pay out more than your earnings?
You're a shrink of the company, right? You can pay out because you've got accumulated assets from previous years. You can get smaller as a company. So if this keeps continuing, it basically means companies are going to get smaller. But this is just publicly traded companies. Maybe this cash is leading these companies and going into the Ubers and the Snaps and the Facebooks of the world, which become new companies. And that's what we might be missing by focusing on that payout.
All right, thanks for explaining that.
Hi. Yeah.
I really liked it. Really understand. It's pretty far above my head, but nonetheless.
Thank you.
Thank you.
Take care. Good luck.
Since you emailed on Monday discussing potentially starting
Just email me again, closer to that.
I will definitely review the strategy.
Okay. Daily is a little too much. Maybe once a week.
Just a question regarding the leverage beta or the sub that we talked about. So my question is, I know that they only have one second analysis. So when I did, and I don't know if this is correct, I tried to look up like similar companies, and range and products and everything. I looked up for like the regression beta, the same way they do with Uber. I put them in, and I that maybe it's a little bit more work is that since most of them are retailers are going to have the leases, right? So should I factor that in as
You
well?
can.
I can.
If you can. If you have capital like you should be able to pull down in the next 5 years and beyond. You should also be able to put up a cost. They have ratings, you can pull up a cost of debt. It's not difficult. Just build it into a spreadsheet. And once you do the one cell, and then you can just copy it down.
Okay.
So basically, it's just pulling up the data from capital like you so that you can do that.
Okay.
So you'll have to do what you did with the case, right? Basically, you have to do the unlevered beta for cash, and you get a pure play beta to do that.
Okay. Thank you.
Hi, how are you?
Just a question on the commodity-linked debt, the more exotic debt options. How do you think about kind of the premium you might have to pay? So do you calculate that or try to figure that out?
That's the thing. So that might be one thing that determines whether you use exchange futures. And maybe if the interest rate that bondholders are demanding is too high, you might say, look, you know what? I'll issue straight debt, and I'll use futures and options and commodities to offset it. But I think if you can, I'd much rather you build it into your debt rather than try to do this, because the problem with futures and options is if you do it consistently, you're okay, but companies don't seem to. They take points of view on oil prices. They skip doing it because they feel good about oil prices for the future, and they do it more when they feel worried. And unfortunately, that timing on when they do it more and when they stop doing it is exactly the wrong timing. So I'd much rather take it out of your hands, put it into the debt, and say, go back and do what I hired you to do. Run an oil company. Be more efficient about the way you extract oil from the ground. Don't pay too much for reserves. Run the business. Don't worry about what oil prices will do to your debt.
Got it. Thank you very much.
Okay.
I have a question
Yeah.
about when you're talking about Baidu, like it looks cheaper to borrow in a foreign currency, but it might not necessarily be true, right?
It will look cheaper because it's a lower inflation currency. Remember, when you have low inflation currencies, everything looks cheaper.
Right.
It's like the same reason the temperature always looks cooler when you check it out in Celsius than in Fahrenheit.
Yes.
If you don't change your frame of reference.
Right.
And what's happening is people's frame of reference is built around what they used to doing. So if you live in a high inflation economy,
Right.
to you 3% interest rates will always look cheap, even though your mind is saying you can't do that.
Right.
3% is in Swiss francs, you usually borrow in Indonesian rupiah. So it
Right.
looks cheap because you can't get your mind around the fact that it's a different currency.
So when you mentioned the mismatch,
Yeah.
Can you explain the mismatch again?
Well, if you borrow in dollars and all your operations are in China,
Yeah.
to the extent that, let's say the Chinese yuan weakens
Right.
for whatever reason,
Mhm.
your assets have become less valuable
Right.
in the local currency terms, but your debt is still in dollar terms.
Right.
You have that steady state problem that I talked about, the Indonesian cab company that borrowed in dollars to
Right.
fund. Is if your currency collapses, you're now caught with debt that's in a different currency that remains invariant to what's happening to your assets.
Right.
So your assets get less valuable, your debt is still what it was
Right.
if you borrowed enough money. It's not a problem with Biden because they have only 5% debt, but if you have 55 or 60% debt,
Okay.
you can overnight go from being a nice, healthy company
Mhm.
to bankrupt
Mhm.
simply because you're not changing exchange rates. It won't
Okay.
cancel.
Right. Okay. All right. That makes sense. Okay.
Good.
Thank you.
Yeah. Omar, right?
Yeah.
Omar.
One is about, it's related to what you were discussing with what Doug was asking
Mhm.
about the fact that you're now looking at also what Natalie was talking
Mhm.
the fact that you're matching the debt or you're taking into account any changes in relative exchange rates with
Right.
with that. So isn't that what we were doing when we were breaking up the equity risk premium of the company into the different countries in which the
No, that
company
has
now
nothing to do with currency risk.
generates revenue? No, but I mean,
That's economic risk. So you can
Right.
make currency risk completely go away. But the reality, if you're investing in Indonesia, you still are exposed to Indonesian country risk because to the extent that the country gets into trouble, your cash flows suffer.
right.
So it's almost independent. So even if you remove currency risk entirely from the picture, in fact, I'm going to argue that if you're a company like Disney, currency risk is not even a risk I should be building into my cost of revenue.
Right.
The risk we're building into the equity risk, that's why we don't build risk premium. You invest in Germany or France. There is currency risk,
Right.
but I don't care. It's economic risk that you're trying to build in through the equity risk premium. So when we talk about a higher equity risk premium being demanded for investing in India, it's not because you worry that the rupee-dollar exchange rate will change.
Right. But
It's because you worry about the Indian economy being more unpredictable.
but if your customer base is, if your entire business model is based on people coming from overseas, or some of it is based on people coming from tourists coming in.
Oh, there,
So
yeah, you could
there
build
is-
an equity risk premium into it.
There is
So
an
it-
influence, like,
Yeah, so in fact, when
other
I did-
Latin American countries.
In fact,
the
when
case
I
of-
did the theme park, I said that rather than use Brazil's equity risk premium, I should be using a weighted average equity risk premium of the countries from which they get their tourists, because you are affected
Right.
economically. So that's a separate issue. You can
Okay.
so you could make currency risk go away, but I'm still going to assess that country risk on you,
Okay.
because that country risk has nothing to do with currencies. It's got to do with the economic underpinnings. If Argentina goes into another crisis, and tourists stop coming from Argentina,
Mm.
they're going to feel it.
Yeah. Okay. And the second thing was about dividends and buybacks. I must have missed
Yeah.
like one sentence. What is the difference in taxation between the two?
In the U.S. or
In the U.S.?
U.S. now it's the same tax. It's 23% involved.
So it doesn't matter.
For 90 years in U.S. from 1913 to 2003, dividends were taxed at ordinary